Hello, today we are going to be thinking hard, and of course we'll be thinking next about the convertibility of the Indian rupee. Now let me ask you a question. What is the most emphatic symbol of a country's economic strength? Now very clearly, the very fact that other countries, other citizens want to hold their wealth, their savings, their reserves in your currency. That is such an emphatic symbol, and it's called how convertible your currency is. Clearly the primary spot in that pecking order belongs to the US dollar. As we just saw in the last episode that we did on the creeping de-dollarization of the global economy, the US dollar accounts for 60% of all invoicing of global trade, plus almost 60% of other countries' foreign reserves and assets are held in the US dollar. So that's the number one currency as far as this particular facet is concerned. There is of course also the British pound, there is the Swiss franc, there is the Japanese yen, there is the euro, and all these currencies have one thing in common: they are fully seamlessly convertible. You can go anywhere in the world, you can use these currencies, you can buy and sell assets in these currencies seamlessly. They are very mobile, they are very seamless, they are fully convertible. There is now a movement towards newer currencies getting added and becoming more internationalized, and this trend is about 1.5 percentage points. So experts feel that this trend will continue until a threshold of about 50% for the US dollar. 50% will be the US dollar and the balance 50% will be other currencies. And out of this 1.5 percentage points which the dollar is losing every year in terms of as a global reserve currency, the rupee is one of the currencies which is gaining. Of course, the Chinese yuan is also gaining, and there are other currencies which are gaining as well. But the fact that the rupee is gaining, and the fact that today India is in a very distinct economic situation, I'm talking about 2023, very distinct economic situation, opens up a whole new opportunity for India. Now remember, China is going through a tough time. The Chinese economy is staring at deflation. The Chinese economy is dealing with a huge crisis in its real estate sector. Big Chinese companies have already defaulted. So the confidence of the world in the Chinese yuan is a bit of a question mark right now. They are still a very large trading country, but the strength and the stability of the Chinese yuan is a bit of a question mark. Of course, also the Chinese yuan is not very easily convertible. On the other hand, India is right now in the pink of macroeconomic health. I mean, whether you look at foreign currency reserves, we've got nearly 600 billion foreign currency reserves. Whether you look at our debt to GDP ratio, we have a very conservative, very low, relatively low debt to GDP. One of the problems that China is facing is that its debt to GDP ratio is huge, very, very high, almost 2.5, 3 times GDP. And that is the point at which countries usually dip into deflation, if we go by the experience of the Japanese economy earlier. But India's under 1 time, and therefore India is very healthy in that count. And of course, the ultimate test: India has never defaulted on any overseas debt obligation. So therefore, we have an impeccable track record, and therefore this gives us the opportunity today to internationalize the rupee. How do we do that? Let me start you off with a little bit of history, and I think then I'll come to the present after that. What has been our track record about internationalizing the rupee? Frankly, it's been terrible. Until 1990, in the first few decades of our independence, the rupee was a totally rigidly controlled currency. You could not trade it, you could not exchange it. The government even administered the price at which you would exchange it with other currencies. The movement of capital in and out of India was severely restricted, if not outrightly banned. Therefore, the rupee was a dud currency when it came to internationalization. And in fact, that's one of the reasons that in the early 1990s, we actually had a terrible foreign exchange crisis. We've all heard of that fabled story, right? When India had to fly its gold out and India had to pledge its gold to stave off a foreign exchange default. Of course, that crisis came with a terrific opportunity, because in the early 90s, we realized that we have to now float the rupee. We have to now have a market value of the rupee if we want to have a sensible economy. And therefore, very swiftly, the rupee was devalued and it was opened up as a currency. And in fact, in the early 90s, we made very purposeful strides. We made very determined strides. For instance, the rupee was made entirely convertible on the current account. What is a current account? If I want to use a service overseas, if I want to pay for a lawyer's fee for a joint venture agreement, I could easily pay it without a problem. So on the current account, the rupee was made fully convertible. On the capital account also, companies were allowed to buy foreign assets under certain conditions. So it was a conditional opening up, but yet it was an opening up. You could buy foreign assets, you could buy foreign property, you could invest in foreign joint ventures, and conversely, foreigners could come into India. So there was a two-way movement which started. There was one area in which India moved very, very swiftly in the early 90s, and that was that the rupee was made fully convertible on the secondary market, on the stock market. So foreigners could come in and buy Indian stocks and Indian bonds, not bonds as much as Indian stocks, which were made completely seamless. Of course, you needed to be registered with SEBI and you needed to be registered with RBI, but once you were registered, the rupee was completely convertible. You could buy Indian, you could bring in the money, bring in dollars, buy Indian shares, and if the price went up, went down, whatever, and you sold Indian shares, you could take the dollars, you could convert the rupees back into dollars and take your dollars out, no questions asked. So that was a very, very strong move the Indian policymakers made at that point in time. And you know what happened? There was a rush of foreign capital into India's stock markets, and the equity markets boomed. I'm talking about the 1990s. So the next logical step after India had so purposefully opened up the rupee to internationalize it in the 90s would have been to actually move towards full capital account convertibility. That means simply that you can buy and sell anything anywhere. You want to buy a share of Apple, you want to buy a house in the Bahamas, you want to buy a company in London, you can do it without any sort of restriction at all. That's a full capital account convertibility. However, unfortunately, in the late 90s, we had that Asian currency crisis in Southeast Asia, Thailand, and those countries were really ravaged. Their currencies were ravaged, and the Indian policymakers obviously got a little bit conservative, and they sort of put a halt on that move towards full capital account convertibility. Then happened 9/11, then happened in 2008 the big financial crisis in America, and effectively the Indian rupee's internationalization got caught in a status quo. Really, we didn't move too much after that. We of course did a few things. We liberalized the overseas direct investment rules. We allowed individuals to use their savings up to a limit of few $100,000 every year, which you could invest in overseas assets or in vacations or in education or in health, whatever. But this was all very limited. There were restrictions, there were end use caps, there was requirements of pre-approvals, etc. So it was an opening up, but a very conditional opening up. Now let's come to 2019, which is the second term, the first budget of the second term of the Modi government. This is when the government tried to break the status quo. They announced that for the very first time, India would launch a sovereign dollar bond. Simply, the government of India would borrow overseas in dollar denominated bonds, which would be listed in overseas stock exchanges, a dollar denominated bond, the very first that India planned to do, and that would have allowed foreign investors to actually engage with Indian assets, hold their value in Indian assets, and that would have been a very very good move to break that status quo which the internationalization of the rupee had gotten trapped in. But to my utter surprise, people on the right, people on the left, people on any side of the economic spectrum, Swadeshis, nationalists, liberalizers, free market thinkers, everybody criticized the move, saying this will open India up to a huge risk. I couldn't get it. We were talking about $10 billion, which is only 3%. It was then 3% of India's foreign exchange reserves. It was only 10% of the government's gross borrowing program for that year. It was a tiny calibrated move. What was so dangerous about it? But there was such a deafening chorus against the move that the government literally got scared, and the government abandoned the move. It aborted the plan, and therefore nothing happened. For the next 4 years again, there was a status quo with limited liberalization, small movements forward. Then this year, 2023, as has often happened in the past, foreigners and others have more confidence in our economy than our own policymakers have. because JP Morgan very recently said that it would include the Government of India bonds in its emerging markets index. And it gave straight away India a 10 percentage points weight, which is what is equal to the weight of China, 10 percentage points. And that is expected to get $20 to $30 billion of passive and active flows into the government bond market. It's also expected that Bloomberg index will now follow suit, and another $20 to $30 billion is likely to come on that account as well. So $50 to $60 billion of overseas capital could flow into the Indian government bond market in next year, 2024 and 2025. And that will be very positive, because it will open up $50 to $60 billion of domestic savings for the private sector. It will bring interest rates down. It will strengthen the rupee. All very positive. Once again, as I said, confidence shown more by foreigners than by our own policymakers. So now it's time, according to me, it's time that we now reciprocate the gesture of the foreigners, the confidence that they have shown, by actually bringing back the idea of the US dollar bond back on the table. I think, Think.Nxt, I think Government of India should now announce a $20 billion. They aborted a $10 billion program. They should now announce a $20 billion program. Why? Because it is still about 3.5% of our foreign currency reserves currently, and also it's less than 5% of the gross borrowing program of the government. So really, it's really nothing, about 5 to 7%. So we should step up and we should do this. Now I know that if the government does it, because it had given in 2019, there's going to be a deafening chorus again. The same naysayers will come out and say, no, this is all wrong, please abandon it. Do not abandon it. Do not abandon it, government. And I'll give you, I'll contest each criticism one by one. They say that the cost of the INR dollar, the dollar bond, the cost in rupees is unquantifiable. Of course it's not. You haven't heard of hedging? You will hedge, and therefore it is not unquantifiable. It's quantifiable on day one, and the hedging cost will get included in the cost of capital. Now they will say, by including the hedging cost in the cost of capital, you are paying a few basis points more than you would pay in India. Of course you are, but look at the advantage of paying that few basis points more. You will get that same amount of capital getting free for the private sector to come and borrow in the Indian domestic savings market, and that would have its own multiplier. So it's not unquantifiable costs at all. Then the second thing is, why go overseas, they say, when the foreigners are already here, because, I just told you about JP Morgan bond index, more foreigners will come in here. That's again a very, very frankly illiterate economic argument, because the foreigners who are coming here are already aware of the risks they are taking when they come here. When the Government of India launches a US dollar bond outside on foreign stock markets, they are accessing an entirely new category of investor who doesn't know, who hasn't held an Indian asset, who therefore is an entirely new person getting conversant with India, getting engaged with the Indian economy, beginning to trust, to hold his or her value and savings in an Indian asset. So it's an entirely new category. It's not the same to say allow more foreigners to come into the Indian market, because we are accessing a completely new subset of investors, and therefore it's additive. It's not substitutable at all. And then of course the old bogey, India could default, India could import a contagion. I really think this kind of an argument now needs to be jettisoned forever. We have not defaulted in 75 years. We are not about to default now, seeing the strength of our economy. So I don't even want to hear these arguments. When it comes to an argument that will import a contagion, this is again an illiterate argument, because how do you import a contagion? You import a contagion by actually foreigners who are invested in India is selling in a panic and then taking dollars outside. So when you ask foreigners to come in here, there you run the risk of importing a contagion. But if you ask foreigners to invest in your asset overseas, they will buy and sell overseas. All the gyrations will stay overseas. The contagion will not be imported. So I don't get how those arguments are trotted out. And finally, of course, the weakest argument against the move is, why do you need to go through all of this? Why don't you just ask the Reserve Bank of India to cut the repo rate? I mean, this is laughable. If markets could be mandated, if free markets could be dictated so easily, then why would anybody do all of this? You would just say, here markets do this, here markets take the index there, here markets bring the interest rate down there, here markets take inflation there. I mean, that's totally illiterate. How can you mandate free markets beyond a point? You have to navigate them, calibrate them through policy moves, and this is one big policy move. So finally, I think it's important, as we started saying, we need to think hard, we need to think next. There is a very concerted move to internationalize the rupee. The foreigners are showing more confidence than our own policymakers. It's about time that we also show equal confidence, reciprocate. We bring back the dollar bond idea as the first step, and then in a period of 3 to 5 years, we take all steps that are necessary to make the rupee nearly fully convertible on the capital account. We need to think next purposefully with determination.